Good afternoon, everyone. Welcome to the Ankerstar Wealth afternoon brief. Didn't get out the morning brief this morning, but as you can tell by the background, we are on the road, not in the office today. Came in last night for the NCAA championship. For the semifinals matches were last night, two of them, Texas won. And now we're in town for Alexa has a camp today, and then we're off to the national championship tomorrow. But such heinous activities going on in the market. I do feel the need to get a video out today, at least talk to a little bit about why that's going on, where we are and where we're going. Before we do, this is a financial education presentation, so you have to do your own due diligence for acting upon anything you hear in this presentation. You can get full disclaimer information available is at ankerstarwealth.com. Now let's get started. We're going to talk about where the market is. We're going to talk about Tesla. Tesla hit a new 52-week low today, or a new year, like 4-year low. Bottom's falling out of it. And then the last thing we're going to talk about is inherited IRAs. There's always some confusion there because we did have the rule change. So we'll talk about those fairly quickly. But what you're looking at is a real live market shot here. We're about with an hour of close on Friday afternoon. You can see everything's in the red after we had a big down day yesterday. So let's talk about where we are with the week. I think the NASDAQ chart is probably the best to take a look at, and we'll focus on the 5-day. So again, this is our week. I'll scroll this up a little bit for you. Here was right here in the yellow, you can see that was the Federal Reserve announcement on Wednesday afternoon at 2 p.m. Eastern. So started the week with some optimism, got that good print Tuesday morning, which is here with the good CPI information. So everything was favorable, and then kind of sold off on that. When it kind of in a high up to the 50 basis point rate hike, which was expected. Once that was announced and Powell started talking, that's when you can see the market started to fall, bounced a bit, and then has fallen ever since, to the tune about 5% on the NASDAQ. So why did that happen? Well, it was the 50 basis points were widely expected to happen when that was announced, but I don't think people liked what Powell said and how he said it. As far as he said, he said what he always says, and what he has to say is that the Federal Reserve is prepared to do whatever it takes to get rid of inflation, right? And that's what we're doing. And he's been very forthright, or the Fed has been very forthright about announcing, kind of keeping everybody in tune with what's going on. They lived up to their word. So I think, why did this happen? People. I like to say none of us is as dumb as all of us. And unfortunately, a market is all of us. So if people are expecting the mother of all recessions coming up, and they're convinced of that, and if they're expecting that this is going to, all rate hikes are bad and that inflation's never going to end, well, that's all going to happen. Excuse me, then they're going to sell off. It's not going to happen, but they're going to take actions in the market that are going to knock the market down until they change their mind. But I'll just remind you, this is what the Federal Reserve has been talking about all year. I think they've got a good plan. Do I think they can engineer a successful, soft landing in 2023? I don't know. And we won't know till then. But a lot of pessimism in the air, big sell-off this week. I think that fades a little bit, and we'll kind of get our feet back under us a little bit towards the end of the month here. So here's where we are. We had the June lows, and then October, and then November bounced off of that. I still don't think we get near these lows. I really don't. So I think we're going to see a little bit of a Santa Claus rally as we finish up the month of December. There is some selling, with tax loss harvesting going on at the end of the year that does affect things. And then, of course, in January, you get the January effect of people dump a bunch of new money in, 401ks, as well as the IRAs. People, fund those up front a lot of times. There's a lot of buying in January. So optimistic towards the end of the year, but certainly been a brutal past couple of days. All right, let's talk about Tesla stock. I get asked upon this, I've been a bear on Tesla for a long time. This is the 1-year chart. You can see it a new 52-week low. Let's just look at the 5-year chart. If you're a Tesla investor, and I've said this from day one, you are believing that Tesla is more than a car company. You would certainly not pay this kind of multiple if you think all they did was make cars. If you think they're going to change the world, or have changed the world, then you could put a bunch of money behind the stock because you don't know how high it's going to go in that case. The only real, what I would tell with folks that ask me about is like, if you believe that in 2024, 2025, there are going to be robo taxis everywhere, individual car ownership will be be waning at that point. And the cars are going to be, Teslas are going to be out there like the little scooters are laying around in big towns now, then you can justify an investment. If not, if they just make cars like General Motors and Ford, can't justify this valuation. It's still way overpriced if it's just a car company. Obviously, there's the Elon Musk effect, but if you may have noticed, if you've turned on the news in the past like 2 weeks or hit up Twitter, that he's a little bit distracted from leading his other companies right now. He's all in on saving Twitter and right sizing it. So, and he just sold, I don't know the exact number, billions, not an exact number, but it was in the billions of dollars worth of shares of Tesla. Well, he's dumping his own stock because he needs to pay off the note that he took out to buy Twitter. I think it was Goldman Sachs that issued that note. But yeah, I mean, he's got other things to do. He's saving the world through saving free speech through Twitter, right? In the meanwhile, in the meantime, the company's just cooking right along. Other folks are bailing on Tesla, but you saw Kathy Wood is a big buyer here. That's also a catalyst a lot of folks use to sell, to be honest, as they think she's crazy. I think she speaks a lot of truth. But certainly, I think that's the minority of people that think that. So anyhow, how far can it go? Don't know. What's the true valuation of Tesla stock? I don't know, probably well below 100 before I would consider buying it. 46p, 28 forward P. I don't know, standard car company is going to be, 7 to 10 PE. So it's got a ways to fall before it's even, correctly valued, if you will. There is some thought out there that Elon Musk is going to get pushed out of leading Tesla. And obviously, if that happens with the stock, I think you could see a 20-30% move that day. Right. So I don't see a reason to own it. If you believe the long-term story, own it. If you don't, and if you're saying, well, it's down so much, it's gone from 400 to 150, that's what, down 60%. It can go down a lot farther. Just ask, Carvana. All right. Last thing I want to talk about today is inherited IRAs. These can be really confusing. But first of all, if it's your spouse, right? If you're above 59 and a half and your spouse passes away, the rules are the same no matter how old you are. But if your spouse passes away, most of the time, the right thing to do is to simply adopt their spouse's IRA into your IRA as if it was your own, and then go about your business, right? Go about your life. However, if you're younger than 59 and a half, you can get into a weird situation where you actually have a choice. You always have a choice. You can take it as an inherited IRA non-spouse too. So if you take, say you're 40 years old and something happens to your spouse, obviously that's a tragedy right in the middle of your life. But if you have enough money, you just, to get by the day to day, you can simply combine IRAs, treat it as your own, and go about normal. However, if you don't have money and you're going to need some of that money out of your deceased spouse's IRA, if you take it into your own and then withdraw it early, you're going to have to pay the 10% penalty. You don't want to do that. But if you take it into an inherited IRA, then you have to distribute it within 10 years. But it gives you that cash flow you may need to get your feet back on the ground from, something as tragic as your spouse passing away right in the middle of your prime years, if you will. So that's one thing considered, either read up about it significantly if that happens to you, or talk to a professional before you have to make that decision. But for everybody else out there, generally it's a parent where you're inheriting the IRA. And if you receive that IRA, then you're a non-spouse beneficiary, right? Because you're a child. Or if it's somebody who left you money that's in an IRA, then you would be a non-spouse, right? The rules now, if they pass away after January 1st of 2020, is you have 10 years to draw down that account. That's right here in blue. Right now, you can take it all at once. You can take it equal amounts. You can take it all in the last year. It doesn't matter. There's no other rules other than you have 10 years to take it. However, if the person passed away before January of 2020, then you're under a life expectancy type rule where you do have to take a distribution every year. So just realize if that's the case, then you want to make sure you're going in and taking that. Again, if you're working with a professional, they'll calculate that for you, let you know what it is, and then give you options for how to take that distribution. However, if you're not, and you're doing this on your own, just realize that that is a minimum that you have to take every year, and the penalty is 50% if you mess it up. So again, it's something that's just like, it's dumb that the penalty is that high, but certainly the government does want you taking that money out. And of course, any money you take out of any traditional IRA under any of these circumstances is taxed as income. So if you are a higher income earner, that's going to hurt. If you're a low income earner, then you have, you may want to take it earlier than later, but because of your tax brackets. But anyhow, a lot of things to think about with IRAs. Take some time and think and, dig into the rules if you have an inherited IRA situation, so you know what you're doing there. So that's all I've got for today's show. Thanks again for listening in. Keep your questions coming. You can pass them to the website or directly to our email at vipservices@ankerstarwealth.com. That's all I've got for today's show, and we'll see you back Monday morning.